Silver right now is sitting in a tight middle ground. That balance may not last much longer as pressure quietly builds under the surface. Over the past year, silver climbed roughly 30% from its recent low, then dropped about 30% from its recent high, leaving price stuck between two powerful forces pulling in opposite directions. While most people see nothing but sideways movement and boring price action, something deeper has shifted that many investors will only understand after the opportunity has already passed them by. Welcome to Alex Carter Reports, where we break this down in plain English so you can see the bigger picture forming in real time. As of this recording, silver in the Western spot market is trading at $82, and futures are also sitting around $82, showing almost no difference between paper and spot pricing in the US markets. Meanwhile, in Shanghai, physical silver is trading closer to $88, and futures there are around $90, which means buyers in the East are paying about $6 more per ounce than traders in the West. That $6 premium has held steady since the last update, and when a price gap like that refuses to close, it usually signals that something important is happening beneath the headlines. When physical buyers consistently pay more than the paper market price, it tells you demand is stronger than the system is willing to admit publicly. This kind of disconnect between East and West rarely resolves quietly because eventually either the physical price rises or the paper price falls until balance returns. Right now, that tension is building instead of fading, and history shows that sustained imbalances often end with sharp moves rather than gentle adjustments. Let's talk about what just happened at COMEX, because this detail matters more than most people realize at first glance. Registered silver inventories at COMEX just dropped below 100 million ounces for the first time in modern tracking history. The current total sits at 98 million ounces after nearly 5 million ounces were drained in a single day, which is not a small movement by any measure. At the same time, March open interest stands around 65,000 contracts, which represents claims on roughly 325 million ounces of silver. That means there are 325 million ounces worth of paper promises, sitting against just 98 million ounces of registered physical metal. The ratio now sits near 3.3 to 1, and when paper claims outweigh physical supply by that margin, risk quietly increases inside the system. First notice day for the March contract is February 27th, which is only 2 weeks away, and that date always matters when inventories are tight. Now, for short-term traders who focus on charts, we also need to address the technical picture, so expectations stay realistic. Recently, silver reclaimed the 150 exponential moving average on the hourly chart, and at the time it looked like potential support might be forming. However, as of this recording, price has slipped back below that level, meaning it failed the test, and the 150 EMA is acting as resistance instead of support. As long as price remains below that moving average, short-term structure suggests weakness is still possible in the paper market. That does not mean silver cannot rise later, but it does mean traders need to understand what the chart is currently signaling. Here at Alex Carter Reports, we are not giving buy signals or telling anyone what to do with their money. We are reading the tape, looking at real data, and explaining what the numbers are showing so you can think clearly for yourself. Capital preservation always comes first, because surviving long enough to see the bigger move is more important than chasing every short-term bounce. The investors who win in the long run are usually the ones who respect risk before they chase opportunity. Now let's zoom out and look at the broader setup that has created this strange equilibrium in the first place. Silver rallied from around $63.90 up to roughly $93, which is about a 30% move higher in a relatively short time. After reaching that high, price corrected back down to around $82, which is about 30% off the top. That symmetrical move left both bulls and bears feeling partially validated, because each side can point to data that supports its argument. Bulls see higher lows and strong long-term fundamentals, while bears see resistance at technical levels and short-term weakness. This type of coiled price action often acts like a spring under pressure, storing energy until one side finally gains control. At the same time, the Silver Institute recently released its latest outlook, confirming a 6th consecutive year of structural deficit. The forecast deficit stands at 67 million ounces, meaning demand is expected to exceed supply again this year. Investment demand surged 20% to 247 million ounces, marking a 3-year high in investor interest. India alone is projected to import roughly 220 million ounces, which represents about 25% of total global annual mine supply. Think about that for a moment, because one country is expected to absorb a quarter of global production by itself. Industrial demand is projected around 650 million ounces, only down slightly due to efficiency improvements in solar manufacturing. Mine production is expected to rise about 1% to 820 million ounces, while recycling increased 7% to top 200 million ounces for the first time since 2012. Even with higher recycling and modest production growth, demand still outpaces supply by 67 million ounces. That marks 6 straight years where more silver is used than mined, creating a steady drain on above-ground inventories. These are not rumors or speculation, because the Silver Institute publishes these numbers publicly for anyone willing to check the data. When deficits continue year after year, physical stockpiles do not magically refill on their own. Eventually, persistent shortages begin to influence price in ways that short-term charts cannot fully explain. Meanwhile, on the geopolitical side, China's combined holdings of U.S. treasuries, stocks, and bonds have fallen to $1.56 trillion, near the lowest level in 14 years. Excluding Belgium-held treasuries widely believed to represent Chinese custodial accounts, total holdings, sit around $1.16 trillion, the lowest since 2008. China's official treasury holdings fell another $6.1 billion in November to $682.6 billion. Reports now suggest that China is encouraging banks to begin selling U.S. treasuries, which signals a longer-term shift in strategy. When the largest foreign holder of U.S. debt steadily reduces exposure over more than a decade, that capital does not simply vanish. Money often flows into commodities, infrastructure, and strategic materials when confidence in currency assets weakens. The World Uncertainty Index has surged above levels seen during the 2020 pandemic and even above the 2008 financial crisis. We are living in a period of extreme global uncertainty, and that kind of environment historically favors hard assets over paper promises. All of this forms the backdrop behind silver's current price compression. On the surface, charts show consolidation and short-term resistance. Underneath, inventories are shrinking, deficits persist, and geopolitical capital flows are shifting. When physical markets in the East are paying a $6 premium while Western futures hold at $82, that divergence cannot last forever. Either the premium collapses or the paper price adjusts upward to meet real demand. In the next phase, we will dig deeper into delivery risk, Shanghai market closures, macroeconomic stress, and why timing over the next 2 weeks may matter more than most realize. For now, understand this clearly. Silver is not quiet because nothing is happening. Silver is quiet because pressure is building. And markets under pressure rarely stay balanced for long. Stay sharp, stay rational, and always verify the data for yourself here at Alex Carter Reports. Now let's move into the timing risk that almost nobody in the mainstream media is talking about, because sometimes what matters most is not just the data itself, but when certain events line up on the calendar. The Shanghai Metals Exchange will be closed from Sunday, February 15th through Monday, February 23rd for the Chinese New Year holiday, which creates an 8-day period where the Eastern physical market goes completely quiet. During that stretch, one of the strongest sources of real, physical silver demand temporarily disappears from daily trading activity. Western banks and large trading desks are fully aware of this seasonal pause, and historically, they have used this window to apply pressure in paper markets when fewer physical buyers are active. When the Shanghai bid steps away, it becomes easier for heavy futures, selling to push prices lower without immediate resistance from Eastern demand. This pattern is not a conspiracy theory pulled from thin air, because anyone can review historical price action during past Shanghai holiday closures and see how volatility often increases during that time. However, this year, there's a key difference that changes the equation in a meaningful way. Before the holiday even begins, China's silver market was already showing record backwardation, meaning the front month contract was trading at a premium to the next active month. In simple terms, buyers are willing to pay more for immediate delivery than for future delivery, which usually signals tight supply in the present moment. Backwardation at extreme levels is not normal in a healthy, well-supplied market where inventories are comfortable and delivery is easy. It often reflects stress in available stockpiles, especially when industrial demand and investment bar demand are both strong at the same time. Reports show that solar manufacturing and investment demand have been pulling silver out of circulation faster than it can be replenished. Short sellers in Shanghai have reportedly been paying deferral fees just to avoid delivering physical metal right now. When traders pay extra money to delay delivery, that tells you the problem is not price, but availability. This is what shortage mechanics look like in real time, even if headline prices do not immediately reflect the tension. So while Shanghai closes for 8 days, the paper market in the West may try to take advantage of thinner global liquidity. But when the exchange reopens on February 24th, the key question will be whether that $6 premium expands further or begins to close. If the premium grows after reopening, it could signal that physical demand remained strong even during the holiday period. Now let's step back and examine the broader economic picture, because silver does not trade in isolation from macro conditions. Recent labor data shows that the jobs-to-worker gap has turned more negative, which historically suggests unemployment may begin rising faster in the coming months. When job openings fall consistently, it usually precedes increases in unemployment rather than economic acceleration. At the same time, 9 large U.S. companies filed for bankruptcy just last week, pushing corporate bankruptcy levels to the highest since the COVID period. Consumer debt defaults have climbed to 4.8%, the highest level in 8 years, which reflects growing stress among households. Employment is weakening, bankruptcies are elevated, and defaults are rising, yet precious metals have been outperforming significantly. Silver has climbed 150% over the past year, while gold has risen about 76% over the same period. That kind of divergence between weakening economic data and rising commodity prices does not usually signal strong economic growth. It often reflects currency debasement combined with supply constraints, where the value of money erodes while real assets hold purchasing power. When central banks expand balance sheets and governments run persistent deficits, inflationary pressures build quietly beneath the surface. Over time, currencies lose buying power even if official inflation statistics fluctuate month to month. This dynamic has played out repeatedly in past debt cycles, where governments choose gradual devaluation over sudden default. Investors who study long-term monetary history recognize that debt burdens are often managed through inflation rather than abrupt collapse. In that environment, hard assets like precious metals tend to act as a hedge against declining currency strength. Now let's connect that macro stress to what is happening at the state level inside the United States. Texas recently announced plans to produce its own gold and silver coins for use in IRA and 401k accounts for residents. The initial batch will be commemorative, but over time the state intends to produce larger volumes for retirement account holdings. Scottsdale Mint is involved in the process, giving the project established minting infrastructure. This development may seem symbolic at first glance, but structurally it represents something much larger. When a state government begins issuing gold and silver coins approved for retirement accounts, it creates official pathways for institutional demand. If Texas proves successful and other states like Florida, Wyoming, or Montana follow a similar path, tens of millions of retirement accounts could gain easier access to physical precious metals. That would represent a structural long-term source of demand tied directly to retirement savings allocation. Retirement accounts are not short-term traders chasing momentum. They are long-duration pools of capital that rebalance over years and decades. Even a small percentage allocation shift toward precious metals at the state level could create steady demand independent of short-term price swings. Now, shift back to the global strategic picture involving critical materials. Morgan Stanley recently projected that demand for rare earth magnets could increase 437 times over the next 25 years. China currently produces about 90% of the world's rare earth magnets, which highlights the concentration risk in strategic supply chains. As countries attempt to rebuild supply independence for defense and technology sectors, commodities tied to advanced manufacturing gain strategic importance. When exchanges create futures markets for critical materials, it signals institutional recognition that these resources are central to national competitiveness. However, futures markets also introduce paper claims that can temporarily mask underlying physical tightness. This dynamic has existed in precious metals for decades, where paper supply often exceeds physical supply on exchanges. The question is not whether paper markets can influence price in the short term, because history shows they can. The real question is what happens when persistent physical shortages collide with expanding paper claims over time. Back at COMEX, nearly 5 million ounces were drained in a single day, including about 2.5 million ounces withdrawn from JP Morgan and roughly 1 million from Loomis. Total registered silver now stands at 98 million ounces, while March open interest still represents around 325 million ounces. February deliveries already exceeded 100% of open interest, which is a detail that deserves careful attention. If March delivery patterns resemble February in any meaningful way, the exchange could face one of the largest physical delivery tests in modern history. Some open interest has rolled from March into May, but even after those rolls, March remains heavy relative to registered supply. This does not guarantee a delivery crisis, because exchanges have mechanisms like cash settlement and contract rolling to manage stress. However, when ratios tighten and delivery demands rise at the same time, inventories shrink, systemic pressure increases. Now let's slow this down and look at the bearish case with clear eyes, because if you only study one side of the argument, you are not investing, you are gambling. March 1st, notice day is approaching quickly, and although February 27th marks first notice, traders still have the ability to roll contracts forward into May instead of standing for delivery. That means a large portion of paper claims can shift into later months, reducing immediate pressure on available registered inventory. Exchanges also have the ability to encourage cash settlement, which allows contracts to close in dollars instead of physical metal when stress builds. Many investors underestimate how many tools the system has to prevent an official delivery failure. Paper markets have operated with tight inventories before, and historically, they have found ways to smooth over disruptions without dramatic headlines. During the 8-day Shanghai closure from February 15th through February 23rd, Western banks may attempt to push prices lower in thinner global conditions. Without active Eastern buyers bidding in real time, it becomes easier to create downward momentum in futures markets. If price drops hard enough, some weak hands could panic and sell, adding fuel to the downside move. Technically, the 150 EMA on the hourly chart has not yet been reclaimed, which means short-term resistance remains intact for now. If silver fails to push back above that level with conviction, chart-focused traders may continue leaning cautious. Corporate bankruptcies are elevated, but they are not yet at full crisis levels. Consumer defaults are rising, but they have not reached catastrophic numbers that would force emergency intervention overnight. The broader economy could drift sideways in a slow stagflation environment without collapsing outright. Paper suppression in precious metals has persisted for decades, despite repeated inventory tightness. There's a long history of volatility spikes fading after intense delivery speculation. So yes, there is a legitimate case for patience and caution in the short term. But now, let's examine the other side with the same discipline and focus. February deliveries exceeded 100% of open interest, which is not a common occurrence in quiet markets. March open interest still represents roughly 325 million ounces, sitting against 98 million ounces of registered supply. India is projected to import approximately 220 million ounces, or about 25% of total global mine production. The Silver Institute has confirmed a sixth consecutive year of structural deficit, with demand exceeding supply by 67 million ounces. Investment demand jumped 20% to 227 million ounces, marking a meaningful increase in physical interest. China entered record backwardation even before its market closed for the holiday. Eastern buyers continue paying about a $6 premium compared to Western pricing. Now, these are not social media rumors or anonymous claims floating around message boards. These numbers come from exchange data, government trade statistics, and published industry reports. When multiple independent data points align in the same direction, they deserve serious attention. Now, think about timing again, because markets often move when pressure and catalysts overlap. February 27th is first notice day. Shanghai reopens on February 24th. March 1st, notice day follows shortly after. That creates a narrow window where reopening Eastern demand could collide with approaching delivery deadlines. If Shanghai premiums expand after reopening, it would suggest that physical demand never truly cooled during the holiday. If March contracts hold steady instead of rolling aggressively into May, delivery pressure could intensify. If COMEX inventories continue draining below 98 million ounces, the ratio between paper and physical widens further. On the other hand, if contracts roll smoothly and premiums shrink, immediate tension could ease temporarily. This is why watching behavior matters more than predicting headlines. The market will reveal its stress level through delivery intentions, inventory changes, and premium movements. Now consider the broader monetary backdrop once more. Silver rising 150% over the past year while economic data weakens does not signal a booming economy. Gold rising 76% during the same period reinforces the message that currency purchasing power is being questioned. When debt levels climb and governments rely on monetary expansion to manage obligations, hard assets tend to attract attention. Currency devaluation rarely happens overnight in dramatic fashion. It usually unfolds gradually, reducing buying power step by step while asset prices rise in nominal terms. Many people mistake rising asset prices for economic strength, when in reality, it can reflect declining currency value. If silver deficits continue year after year, above-ground inventories eventually reach levels that cannot support constant drawdowns. Supply chains for industrial demand do not operate on hope or sentiment. They operate on available material. Solar panels, electronics, and emerging technologies require real metal, not futures contracts. As rare earth demand is projected to increase 477 times over the next 25 years, strategic materials gain geopolitical importance. China, producing roughly 90% of rare earth magnets, shows how concentrated supply chains can become. Governments recognize these vulnerabilities, and strategic repositioning is already underway. China, reducing U.S. Treasury holdings to $1.56 trillion and excluding Belgium-held accounts down to $1.16 trillion, reflects long-term capital reallocation. Official holdings falling to $682.6 billion after a $6.1 billion reduction. In November, signal steady divestment. When major global players reduce dollar exposure, alternative assets often benefit over time. Commodities, infrastructure, and tangible resources become more attractive in uncertain monetary environments. The World Uncertainty Index surpassing pandemic and financial crisis levels underscores how unstable global conditions feel. Periods of extreme uncertainty historically coincide with stronger performance in hard assets compared to financial claims. This does not guarantee straight-line gains because volatility remains part of every cycle. But structural deficits combined with geopolitical shifts create a foundation that cannot be ignored. The question is not whether volatility will occur, because it always does. The real question is whether long-term pressure is building faster than short-term suppression can contain it. If paper claims continue exceeding physical supply by more than 3 to 1 while inventories decline, imbalance grows. If state-level initiatives like Texas, minting gold and silver coins for IRA and 401k, expand to other states, structural demand broadens. Retirement accounts allocating even small percentages toward precious metals could create steady inflows. Institutional access often changes market dynamics more than retail enthusiasm ever could. At Alex Carter Reports, the goal is not to create hype, but to connect documented data points into a coherent framework. We are not predicting a specific price target. We are not promising a specific date for a breakout. We are observing that multiple stress signals are appearing simultaneously across physical supply, macro conditions, and geopolitical shifts. Markets can remain compressed longer than many expect, but when compression finally releases, the move is often faster than most are prepared for. Now everything comes down to observation, discipline, and understanding what truly matters over the next several days, because markets often whisper before they shout. The calendar is not just a series of dates right now, it is a sequence of pressure points that could determine whether silver remains compressed or begins to move decisively. February 24th marks the reopening of the Shanghai Metals Exchange after the Chinese New Year closure, and that reopening will immediately show whether Eastern demand steps back in aggressively. If the $6 premium between Shanghai pricing and Western pricing expands beyond current levels, it will signal that physical buyers are still willing to pay up despite recent volatility. If that premium narrows quickly, it could suggest temporary cooling in demand or successful short-term suppression in futures markets. February 27th is first notice day for March contracts, and that date always reveals who intends to stand for delivery versus who prefers to roll forward. If a meaningful portion of the roughly 65,000 contracts chooses delivery instead of rolling into May, pressure on the 98 million ounces of registered inventory increases instantly. Remember, those 65,000 contracts represent about 325 million ounces of silver claims, which is more than 3 times the registered supply. The system does not require all contracts to demand delivery for stress to appear. It only takes enough to tighten available stock significantly. March 1st follows closely, and by that point, the behavior of traders will already be visible through open interest changes and inventory updates. Watch whether COMEX registered inventories continue declining below 98 million ounces or stabilize near that level. Watch whether daily withdrawal numbers remain elevated, because steady drainage over time matters more than one dramatic headline. Watch whether SLV experiences renewed inflows of physical metal even during price dips, because that would signal persistent demand beneath surface volatility. If banks need to buy back futures contracts aggressively to manage exposure, upward price movement can accelerate quickly. If they rely more heavily on cash settlement and contract rolling, immediate upward pressure may be delayed but not eliminated. Technical traders will continue monitoring the 150 EMA level because reclaiming that level with strength would shift short-term momentum. Failure to reclaim it may invite additional downside probes designed to shake out weak holders before any larger move unfolds. Markets often test conviction before rewarding patience, especially in environments where paper leverage exceeds physical supply. Now consider the broader narrative forming simultaneously. 6 consecutive years of structural silver deficits are not noise. They represent cumulative inventory drawdown across global markets. A 67 million ounce deficit in a single year compounds when it repeats annually. India importing roughly 220 million ounces, or about 25% of global mine supply, represents concentrated demand that cannot be ignored. Industrial demand near 650 million ounces remains substantial, even with minor efficiency gains in solar manufacturing. Mine production increasing only 1% to around 820 million ounces does not fully offset expanding demand trends. Recycling topping 200 million ounces for the first time since 2012 helps, but it does not erase structural imbalance. These numbers form a supply and demand framework that exists independently of daily chart patterns. At the same time, China reducing U.S. Treasury exposure to $1.56 trillion overall and to about $1.16 trillion, excluding Belgium-held accounts, reflects long-term monetary repositioning. Official holdings declining to $682.6 billion after a $6.1 billion monthly reduction signaled gradual but consistent divestment. When major global players diversify away from dollar-denominated assets, capital often rotates toward tangible resources. The World Uncertainty Index sitting above pandemic and financial crisis highs underscores how unstable global conditions feel. Periods of elevated uncertainty historically drive interest in assets perceived as stores of value. Silver's 150% rise over the past year and gold's 76% rise are not occurring in isolation from weakening economic signals. 9 large corporate bankruptcies in a single week, consumer defaults at 4.8%, and softening labor data reflect underlying stress. When currencies weaken and debt burdens expand, hard assets often rise even as the real economy struggles. State-level initiatives like Texas producing gold and silver coins for IRA and 401k introduce new structural access points. If other states follow that model, millions of retirement accounts could gain simplified pathways to allocate toward physical precious metals. Retirement capital does not move quickly, but when it moves, it often moves steadily and persistently. Institutional demand built into state policy frameworks represents a different kind of buyer than short-term speculators. All of these forces intersect at once: tightening inventories, geopolitical repositioning, macroeconomic stress, and expanding access channels. Short-term volatility does not erase long-term structural dynamics, but long-term structural dynamics do not prevent short-term volatility either. This is why risk management remains essential. Capital preservation allows you to stay present long enough to respond when clarity increases. Chasing emotional moves without data discipline often leads to unnecessary losses. Ignoring documented supply imbalances can lead to missed opportunities. Balance comes from studying both the bearish tools within the system and the bullish pressures building beneath it. Over the next 2 weeks, behavior matters more than commentary. Observe delivery intentions as they update. Observe Shanghai premiums once trading resumes on February 24th. Observe whether the March contract rolls aggressively or holds firm into first notice. Observe whether COMEX registered supply stabilizes above 98 million ounces or continues drifting lower. Observe whether price reclaims the 150 EMA convincingly or repeatedly rejects beneath it. Markets rarely announce turning points in advance. They reveal them through subtle data shifts that only disciplined observers catch early. At Alex Carter Reports, the mission is simple. Verify independently, think critically, and connect real numbers instead of chasing headlines. This is not a promise of immediate upside, and it is not a prediction of collapse. It is a recognition that silver sits at a measurable equilibrium point where multiple pressures are converging. Paper markets can delay resolution, but they cannot permanently override physical reality if imbalances persist. Eventually, either demand cools, supply expands meaningfully, or price adjusts to restore balance. Right now, deficits continue, inventories remain historically tight, and global uncertainty stays elevated. That combination deserves attention, not emotion. Your capital is your responsibility. Your research is your edge. Your patience is your protection. Stay focused, stay logical, and watch the data closely as these key dates unfold. Because when compression finally releases, it rarely asks for permission first. This is Alex Carter Reports, and the numbers will tell the story soon enough.